Hi everyone, Chuck Gibson at Financial Perspectives here. I want to try something a bit different, kicking off the new year. I'm going to provide a monthly market update in video format, this one being the first, in hopes of keeping those who are interested more up to date, but also provide a different perspective than what you may hear from the mainstream media. Additionally, unlike the prior 3 years, I do think 2015 will provide its challenges and test market participants. So if you're so inclined, these updates may help put the expected volatility into perspective. 2015 got off to a rough start as the major U.S. averages kicked off the year with a 4-day sell-off, something that never happened in 2014. The question we're pondering, is this the beginning of something much bigger? A harbinger of what's ahead for the year? Or is it just that volatility has finally crept back into the markets? Nobody knows the answer to this question, and the markets will eventually show their hands. So in the meantime, we monitor and examine, looking for clues. In our model portfolio, we made 2 changes during the month. First off, we sold half our position, locking in more than a 25% profit on the TLT long bond investment made in the first half of last year. We feel there's more upside in that position, but wanted to take some profits off the table as it's very overbought at this time. Secondly, we added one individual stock, Jan, selling a portion of our existing PKW position in order to not increase asset allocation. And speaking of asset allocation, our model as of the end of January is still telling us to be fully invested. A couple of the indicators are close to flipping, which if they did, would give us a signal to take the risk down a notch or 2 in your portfolios. But until that happens, we're staying fully invested. In an attempt to keep some consistency in these videos, I plan on using about half the time to look at U.S. sector performance, the broad U.S. stock market via the S&P 500, EFA, which is the world developed markets, excluding the United States, the emerging market stocks via EEM, commodities via the CRB index, and finally U.S. bonds. The balance of the time remaining will be used to highlight any other interesting activities, such as opportunities maybe, in other markets that are noteworthy and not covered in the first section. With that said, let's jump right into the charts. As you can see in our first chart, sector performance, our model portfolio overweighting in healthcare, consumer staples and utilities, and the avoidance of energy and financials was the right theme for January. We see nothing in the near term that will likely change this much. Energy is more oversold than any time in the past decade, and at some point in time will provide a good long-term investment. But I don't believe that time is now. I continue to watch with anticipation, but there is nothing telling me we should see a bottom any time earlier than the second half of this year, or maybe even much longer. The next chart of the S&P 500, you can see we've been in a strong uptrend since the 2011 bottom, making higher highs and higher lows. It appears as if we're in the middle of a correction right now, as prices are consolidating from their December highs, trying to digest the overbought condition. Stochastics have just dipped below the 80 line, and the divergence on both oscillators are present. Continued downside should find support at the 200-day moving average, which is at 1975. If that does not hold, a test of the blue uptrend line is next at 1900. Got to remember, corrections are normal and desired for an ongoing bull market, so we need to take it for what it is. What is most important is not the correction, but what happens and where do prices go after the correction. A move to new highs is what I expect, but if I'm wrong, that will likely trigger us to reduce risk. In our next chart of EFA, which is the world developed markets, excluding the United States, you can see it's been on a model sell signal since September of last year. It's been consolidating sideways, bouncing along that red horizontal support for 3 months now. If it breaks down, the price objective from that fall would be about a 20% decline from this week's close. If support holds, the ECB decision to print money through 2016 could provide the incentive for a price move much higher. As such, it's make or break it time for EFA right now. In my next chart of the emerging markets, the symmetrical triangle that I've outlined in blue has done exactly what it's expected. It's confused and frustrated anybody foolish enough to use it as a guide. There's nothing attractive at all about this chart, and I see nothing technically or fundamentally to change that anytime soon. My next chart here is a 4-year look at the 20-year U.S. Treasury bond. I gotta say, we got this one exactly right. We called the breakout after the double bottom back in the middle of last year. Prices moved up more than 25% since that call. This is exactly how trend following is supposed to work and how our model capitalized. That being said, we are massively overbought and due for at least a pullback and maybe more. The next chart is a much longer look at that same U.S. Treasury bond, and it shows how for the past 20 years, prices move nicely within those blue channel lines. As you can see, we are approaching the upper bounds of the channel, which has historically acted as a reversal point and provided one more reason for us to take those profits. While the bearish sentiment has lightened up slightly, the majority of the market still believes interest rates have to rise. I'm in the camp that not only will we see lower rates, they may once again surprise everybody at how low they could go. My next chart of commodities is another example of a symmetrical triangle at work. You see a breakout, a move higher, and then a breakdown. Once again, frustrating both bulls and bears alike. As you can see though, commodities have been in a free fall since the breakdown in December of last year. This is not a surprise, as is exactly when we saw a breakout of the US dollar. Since the two move inversely, and until we get some relief in dollar strength, commodities like the emerging markets are something I'm going to be avoiding. Speaking of the US dollar, just like the US bond breakout, we caught the dollar breakout on cue and added it to the model portfolio to capitalize on what should be a very strong, lengthy trend. You might notice I have extended the time frame on this chart to help show the base from which the breakout occurred. As you can see, it started back in 2006. The importance of this is that the upside target from a base of this type of pattern is proportional to the size of the base. So, as much as it's difficult to say, as all the dollar collapse believers are going to be sending me hate mail, the chart is telling me we're in for a long, multi-year, strong dollar environment. If true, the ramifications for both investing and life in general will likely be more significant and potentially radically different than what anybody is expecting. My next chart of oil is really an ugly chart, and you gotta be an unhappy camper if you had any exposure to oil during this decline. Thankfully, our long-term model provided a sell signal that helped us sit in the sidelines and just watch. Note the symmetry of the decline on the right side of the chart and the price rise on the left side of the chart. This is quite common. While prices usually fall faster, they tend to follow a similar path and find support and resistance at the exact same places. That being said, and while many are predicting a bottom, if symmetry is to hold, then the charts are telling us the decline isn't over and most likely won't be until at least the $35 to $40 per barrel level. While this has been a traumatic if you were an investor, I'm salivating because I know at some point in time this could present a generational low in prices and an investment opportunity of a lifetime. We just need to be patient and let it all play out. Market collapses, whether it's oil in 2014 or stocks in 2008, happen all the time. And it will continue to happen as long as human beings are the market. The key is to survive with most of your capital and have the intestinal fortitude to invest on the other side when there's blood in the streets. I think we'll see this unfold in due time. My next chart is of the U.S. banking index. I can't stress the importance of this index as it typically acts as an early warning signal to the markets, a leading indicator of future broad market direction, if you will. But a good example was in 2007. This index began to roll over and make lower lows months before the broad market did. In looking at the chart today, what you can see is that while we're still making higher highs, the difference between the highs is shrinking, and we're starting to see a gentle rolling and topping of price. Since tops are a process, and if this one is one, now I'm not saying it is, what we will be looking for is price to rally one more time, except this time make a lower high. Now let's look at a sector that's just the opposite of the banks. This is the chart of the biotech. This is exactly what you want your chart to look like on all the investments. The strength of this market, in spite of its volatility, is unbelievably impressive, but you gotta be able to stomach its price swings. Those that bought in, strapped in, and held their noses have been handsomely rewarded, as you can see in the bottom pane of the chart, as this index has outperformed the S&P by more than 60% over the past 3 years. If the bull market is going to continue, this is one place where you and I both want to be. And now to close out January's look at the charts, I want to present the VIX, which is a measure of market volatility. The simplest way to think of this is that the greater the VIX, the greater the price swings both up and down of market prices. What you should notice is that from 2011 through the middle of last year, market volatility has been muted and in a downtrend. As such, prices just grinded higher. But the beginning of the second half of last year, volatility has been on the upswing, so far peaking in January. At this point, considering all that the markets have to worry about, I don't think that this is going to abate anytime soon. So we need to get prepared and accept this. To wrap this up, and I'm running out of time, while the longer term charts are still very bullish, the shorter term charts are raising a warning flag. We've moved from a trending up to consolidation. And as you know, consolidation is a normal part of all markets. And once the consolidation is over, a new trend will begin. The $64,000 question is whether or not that new trend will be a continuation higher or a reversal lower. Unfortunately, we won't know until we actually see it in the rearview mirror. I leave you with this one final tidbit, knowing we are starting our 7th consecutive year of this bull market. There has never been more than 7 years without a bear market, or at least a negative calendar year, or both, in at least 144 years of the U.S. stock market. Will 2015 be the first? Whether it turns out to be different this time or not, I'm excited and confidently prepared for whatever the market throws at us.